John Kaufman here, July 7th, 2021, doing the TheoTrade evening video. The markets, well, they turned downright sketchy inside of trade today, especially if you're watching the Nasdaq pretty much right after the bell. I'm going to describe what downright sketchy amounts to and what we're very likely to see moving forward the next couple of days of trade. Listen, people, this is pivotal. By the way, the FOMC minutes came out today, and that did absolutely unequivocally nothing to the marketplace. We actually bid a little higher, sold off, we laughed, we cried. But if you're worried about the Fed, forget about it. It didn't really impede upon the markets. Overall, where we stand here just a few minutes after the close, yeah, you know what? The S&Ps, they closed up some 15 handles. How? That is a wonderful question. When I was talking about some of the sketchy trade a moment ago, what I'm really referencing, I don't know, how about this for sketchy trade? So bell goes off this morning. The Nasdaq has a fairly fierce drop right out of the gate, hitting a high of 14,883 and dropping almost immediately by about 50 handles. And that happened all inside of about 3 to 4 minutes. All right, but 50 handles, we've seen that before. No, it proceeded to drop from that, 14,883 all the way down here into about 14,720 and change. You had about a 160-point Nasdaq drop before, again, some sketched out trade, a little bit of a rally. We sold off, we laughed, we cried. The Nasdaq somehow pulls out a 25 handle gain, which, hey, listen, in Nasdaq language, that is massively unchanged in the trading session. But when you start to look at the marketplace, be as objective as you possibly can. We have seen umpteen days of upside activity in the marketplace. In fact, let's look at the spiders here. What do you got? I mean, you have to laugh about it at this point. You've got, I don't know, 3-4 weeks in a row that we're just grinding to the upside and rather fierce, obviously, over the last 2 trading sessions. Now, yesterday we had a bit of a reversal in the spiders, but what did we do? Rally back up. Yesterday, the spiders only closed down mildly. Today, okay, kind of some wild sell side activity. What did we do by the end of the day? We rallied. Spiders closing up again, $1.50, which amounts to about $15 inside of the S&Ps. But as I was saying a moment ago, trade just got downright sketchy. Let me show you why markets right now are so, if you will, destabilized. A lot of people have been pointing to the advanced decline line. If you looked at the AD line yesterday, it was pretty horrific. It was pretty horrific, and the marketplace had actually rallied back. That had a lot of people a little bit perplexed. Today, the advanced decline line is very much largely a slop fest. But some of that sketchy trade, I mean, I've looked at the markets for 20 plus years, but I can't remember a time, okay, that so many, like what we term kind of risk on, risk off products. There are so many products right now on the screen that are pointing to dramatic amounts of risk. The marketplace just feels like impervious to it. And I can't stress that enough. Like this morning, I mean, I literally got on the first hour this morning. I'm saying, like, it just, something doesn't feel right in the marketplace. And, you can't necessarily put your finger on it. Let me show you some of these, like, quote unquote, risk on, kind of risk off assets. One of the easiest things to start with here, before we start going into individual stocks and so forth, one of the easiest things to point out, take a look at the bond market recently. I mean, the bond market, it's flying. And instead of looking at the bond futures ZB kind of intimidates people. I'm going to look at the TLT, and I'll tell you why. I'm going to apply auto expected moves. And I'm just going to zoom into some of the most recent weeks. Something that we have not been mentioning enough lately is the number of breaches of expected moves inside of the bond products. Bonds in general, okay, the notional value that trades through the bonds is just absolutely unequivocally immense, right? And when I say notional value, it's like how much capital is moving through the bond market. All of it, huge, massive amounts are moving through it. And one of the things that really has got me and a lot of other traders perplexed, how can you have 1, okay, 2, 3, 4, it's 5 weeks in a row where the options marketplace doesn't just have it wrong. These are expected moves being shattered in 5 consecutive weeks. I was talking about 2 weeks ago on a weekend update, I was talking about inefficiency in a marketplace and how inefficiency, well, breeds more inefficiency. The marketplace feels like it's kind of coming apart at the seams. This is precisely what I'm trying to reference. Now, this, okay, can be looked at a lot of different ways. Hey, listen, you can just say there's momentum in here and people are buying bonds, not just because they're scared. More often than not, when people say, oh, they're diving into the bonds, this is where, people go to hide money when they think that the S&Ps are going to sell off. At this point in time, I disagree with that. I really would. And I'm ever the bear, but I would disagree with that. I believe what you're actually seeing inside of the bond market right now is literally just banks jumping onto the momentum and continue to buy it. Why not ride that pony until you can ride it and no more? But the bonds, when they do pull back, this could be a wild, vicious, and woolly trade. The reason I am actually bringing this to your attention is because we've talked about this a lot. As the bonds trade higher, the interest rates are going lower, substantially lower. Like the 10-year, we're going to be looking at, 1.3%. Neither here nor there. I'll push that aside. But the interest rate going lower, okay, this is, again, it's a big, positive for tech. This is a real positive for tech because rates are going lower. Unfortunately, it's killing the financials. What happens, though, when we actually rapidly reverse back and rates could explode higher? Could it actually kill tech? That is one of the considerations here. So when I say that trade gets a little bit downright sketchy, this is sketchy. Seeing bonds rally this much, sooner or later, the pullback in bonds could be a vicious hit to the tech marketplace. And again, that's not necessarily impeding upon markets at this point in time, but hesitation is getting there. And I'll show you what hesitation means. Did you look at volatility futures? When was the last time that you saw the S&Ps end up on the day by 15 handles? Volatility futures actually finished up. VIX finished rather flat. If you start looking down the list, you have a VVIX that's actually trading back in the 113 handle. Longer term volatility is picking up. Like, again, something doesn't feel right in the marketplace. Obviously, we're going to look at the Russell here momentarily, but I'll bring that up again, just a few moments. So you have the bond market that's just a rip roaring rally. Tech loves it, and you can feel it. I mean, you can feel it inside of, Microsoft, which has been a freight train to the upside. You can feel it inside of Apple, it's been a freight train to the upside. Apparently, Tesla has not. Tesla's kind of the odd stock out. Today, also, Facebook reverted back down. Interestingly enough, if you look at Facebook and auto expected moves, it's not just down on the week, it's actually down. It's halfway home to the edge of the expected move. Tesla, get this, Tesla is at the bottom edge of its expected move. Speaking of Tesla at the bottom edge of the expected move, and this is also, I think it's fairly critical that we go through a couple of this. So Tesla's at the lower edge of the expected move. The financials are at the lower edge of the expected move. The energy sector has smashed through the lower edge of its expected move. Where else do you want to go? The emerging markets are below the edge of the expected move. I mean, again, I could go on and on and on. I can go to individual stocks if you want me to, but how often have you seen, again, you've got what? The financials, it's a pretty big sector, along with energy, huge. Emerging markets, also huge. They're not only at the lower edge of the expected move, they're breaking down at this point in time. What's the S&P look like at the exact same time? Interestingly enough, the S&Ps on the week, for the most part, are massively unchanged. And that's why I say, there's a sketchy feel to this environment of trade, because you are seeing capital flowing into bonds. You are seeing, again, with the marketplace up, volatility ever so slightly bid. And that's some of the nuances that you have to be able to read into. You see oil coming off, and sure, oil can be blamed directly for the energy market coming off, but that doesn't describe, while individual products here like Boeing, this thing can absolutely not catch a bid right now. A number of key sectors and a number of key stocks are literally breaking down in the marketplace, but the S&Ps are ending higher. Why? Hey, some solo stocks out there. And this is where a lot of traders, we're going to ride this pony till we could ride it no more. Except, again, sketchy trade. Look at, Google ends the day, for the most part, massively unchanged. Almost no volatility in there whatsoever. Amazon looks very, very similar. Amazon, sure, it's got a bid under it. It's $20. The only thing moving today, we're playing what? Musical chairs of the marketplace, or the shell game, if you will. Apple gets a bid, and as I said, Microsoft gets a bid. And in the end, what are you left with? Literally at this point, 2 or 3 stocks that are sustaining the bid inside of the S&Ps. And that's why, as I said, I'm quantifying this as some really sketchy trade. The other thing that's kind of got a lot of traders perplexed right now, the dollar is on an absolute unequivocal tear to the upside, but it does not seem to be impeding upon gold in the last couple of trading sessions. So we've actually got the dollar rallying, okay, and ultimately, a metal rallying effectively with it. Bonds are rallying in here, as I said, risk on, risk off assets. Absolutely not. It's complete and total free for all right now. I think you have to expect the remainder of this week is going to be chopped out. It's going to be fast. It's going to be rather volatile trade. We attempted to sell off today right before rallying back. I believe that more attempts are going to happen as the week progresses. One thing I always state, okay, on a Wednesday, and I know, again, we have a shortened holiday trading session, but again, inside of the SPX, we've literally had like no movement. We're like unchanged in the week according to SPX. There's a $42 move being priced in higher or a $42 move lower. I think you should anticipate every ounce of it. I mean, we already saw on Tuesday, we literally tagged the lower edge of the expected move. So that box has already been checked. But the key point over here isn't just about the edge of the expected move. The key point over here is that you've now seen 5 consecutive weeks to where the bonds have actually cracked through their expected move, okay? And right now, what are we riding on? 3 consecutive weeks inside of the SPX. I think you should look for some substantial movement the remainder of this week, okay? And use that movement effectively to sell some options premium in back month stuff. Again, back month volatility is high relative to front month. You may look at the VIX and be, oh, the VIX is only 16. Back month options are still trading for like a 20% implied volatility. Okay. The rest of this week, as I said, it's going to be downright sketchy. Look for some wild reversals in trade. Take advantage of them. Again, Russell breaking the lower edge of the expected move. All right. TLT breaking to the upside. Dogs and cats living together. This is going to turn into a trader's market extremely soon. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.